The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. The S&P 500 now down 4.93. We're watching it closely. Are we seeing a reversal? We're going to keep an eye on that. The 10-year Treasury, 2.616. We've got a very strong level of support at 2.57. We've been dropping significantly over the last few weeks. Strong level of support at 2.579 roughly. So we're going to watch that one. Mortgage-backed securities up 13 basis points. That means interest rates are down a little bit, continuing that downward trend. If you bought a home in the last couple of months, maybe you want to give us a call at 800-306-1990 and see if we can save you some money on that more and restructure that loan before rates go back up. OBMMI provides the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgages. Friday's numbers, 30-year conforming loan locked at 5.302. The 15-year at 4.472. The jumbos, 5.024. Best loan on the market, the VA loan, 4.998. FHA, 5.269. And we will share with you, and I don't have my chart from Friday, although I bet Josh can pull it up quick enough, is Friday's chart of Thursday's chart of OBMMI. Because we always like to give you this as a reference so you have an idea of what's going on. Freddie Mac came out on Thursday and said that rates were at 5.30 and you had to pay 0.8 of a point to get it. That was the Thursday number. Well, if you look at Thursday's OBMMI numbers, do you think they're the exact same as what the Freddie Mac came out with? Thanks, Josh. So he just put up Thursday's numbers. Well, conforming loans, 5.424. So Freddie Mac says 5.3, and OBMMI actually locked at 5.424, more current, more accurate data. So be aware that just because that's what you hear on the news, it's not always correct. And let's take a look and see why the markets are doing what they're doing. So obviously the biggest thing is still the fact that we've got significant amounts of inflation going on. So the Federal Reserve, they're part of our problem. We know that. We've talked about it for the longest time. The Fed wanted to see higher inflation. Be careful what you wish for. The most recent reading of the CPI inflation showed inflation at 9.1%. I just told you that in the last segment, 9.1%. Fed has been hiking rates, and the Fed funds rate now stands between a range of 2.25 to 2.5. Many of the markets are now thinking the Fed may begin to pause or reduce their pace. But we heard some comments from a few Fed members this morning that are contrary. The Minneapolis Fed president, Neil Kashkari, he's done a horrible job, came out and said the Fed will continue to fight inflation even if we are headed into a recession. It's interesting to see his shift. Last year, he warned the Fed to not react to inflationary pressure and hike rates because inflation would be temporary.
You know better than that.
Yeah, thanks, Mr. Kashkari. You really know a lot of what you're talking about. It's interesting to see, again, his shift there. He also said 3 months ago he was expecting inflation to ease. Well, we all do. Is it going to be this year, though, Mr. Kashkari? I just wonder about that. New York Fed President Bill Dudley came out and said that thinking the Fed would not tighten much further is wishful thinking, is both unfounded and counterproductive. He believes the Fed will focus on inflation and not recession, and that they will need to tighten much further. The most lagging of economic indicators, the unemployment rate, has now become, again, the most important monthly data point along with CPI because it will be that rather than the GDP that will more influence how much tightening the Fed has left in them. We're going to see that the unemployment numbers will come out this Friday. Something else to keep an eye on that can influence inflation. I told you about that in the last segment. Oil prices. So we're seeing that the futures are giving us an indication that oil may be going back to 120 or 130 a barrel. That's not exciting news, but it is the news. Again, we just watch what it's doing there. So markets are expecting a 250,000 jobs created. Remember last month, the household survey, now we had the BLS survey created to about 300,000. The household survey lost 300,000. So it'll be interesting to see which way we go this time. And we are on some important technical analysis numbers. I'm not going to get into that with you right now. Just know that our team watches the technicals. And when there's not a lot of news of the day, it's the technicals that will tell you what's going on. That'll lead the market. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990.